Hi everyone, I'm James. This is probably one of the most exciting times to talk about IPOs. We have just witnessed the largest IPO in history with SpaceX, and companies like OpenAI and Anthropic are expected to follow in the coming months. Whenever a company like this goes public, millions of investors ask the same question: should I buy it? In this video, I want to argue that long-term investors might be asking the wrong question. Instead of asking, should I buy it? I think the more important question is, when should I buy it? Those two questions sound similar, but they are fundamentally different. The first is about whether it is a good company to invest in. The second is about whether the IPO is the best time to invest. And that's the question we'll explore today. To understand why IPOs are so exciting, we need to start with what a company looks like before it goes public. Before an IPO, a company is privately owned. Its shares are held by founders, employees, and early investors like venture capital and private equity firms. An IPO changes that. For the first time, ordinary investors can buy shares in the company on the share market. Some existing investors may also sell part of their stake, turning years of ownership into realized gains. But there's something I've always found interesting about this moment. At the exact moment you finally have an opportunity to buy the company, who actually knows it best? Is it the investor reading the prospectus for the first time? Or is it the founders, management team, employees, and early investors who has been involved for years? That gap in knowledge is one of the most important ideas in understanding IPOs. To understand this, there's a concept in economics called information asymmetry. It simply means one side of a transaction knows more than the other. And in an IPO, that gap becomes very obvious. Because insiders don't just know the company, they have seen it firsthand. They understand customer behavior, internal forecasts, product delays, pricing power, company culture, competitive threats, and hiring challenges. Now compare that to public investors. Most of the time, you are working with a prospectus, historical financials, and media interviews. And the prospectus is important. It exists for a reason and contains a lot of detail. But it's still a snapshot of the business at a point in time. It can't fully capture things like execution ability, management quality, or how future demand might actually evolve in practice. This isn't a new idea. Economist George Akerlof, who later won the Nobel Prize, wrote about this back in 1970. His key insight was simple. Markets become less efficient when one side has significantly more information than the other. And an IPO is one of the most obvious real-world examples of that idea. This information gap also helps explain something you often see in IPOs. On day one, the share price sometimes jumps above the IPO price. That's called IPO underpricing. But it's important not to overinterpret it. It doesn't happen in every IPO, and it's not a rule of the market. It usually shows up when there's still a lot of uncertainty about how a company should actually be valued. From the underwriter's point of view, the goal is simple. Don't get it wrong on the downside. Price it too high and the deal can fail. So the IPO price is often set a bit cautiously to make sure the listing goes smoothly. Which means the IPO price isn't really the final answer on value. It's more like a starting estimate under uncertainty. Then trading begins and the market immediately starts adjusting it, based on real demand, real information, real money. So even on day one, the price isn't fixed, it's being discovered. And that leads directly into what happened next: price discovery. If everything was already known at IPO, why does the share price often move so much in the months that follow? The answer is simple. The IPO is not the end of valuation, it's the beginning of price discovery. At the IPO, investors mainly rely on the prospectus, roadshow materials, and historical financials. That gives you a starting point, but not a complete picture of the business. Once a company starts trading publicly, new information begins to enter the market. The first major update is the earnings report. This is often where expectation meet reality for the first time. Take Airbnb for example. At IPO, investors were still uncertain about how travel demand would recover and stabilize after the pandemic. But over the following quarters, earnings reports start to answer those questions through real data on bookings, revenue growth, and margins. This is where the market begins to shift from expectations to evidence. At the same time, analysts begin covering the company. They update models, revise forecasts, and test management assumptions more aggressively. Over time, this helps refine how the market understands the business. Take Meta Platforms as an example. In its early years as a public company, analyst views evolve significantly as the business shifts from desktop advertising toward mobile and later into broader digital platforms. Each revision helped the market form a clearer view of what the company could actually become. Then comes another important moment, the end of the lockup period. In most IPOs, early investors and insiders are restricted from selling their shares for a period of time, usually around 6 months. When that restriction expires, more shares become available to trade, and some early investors choose to reduce their holdings. Take Beyond Meat as an example. After its IPO, it attracted a large amount of attention and strong early momentum. So when the lockup period ended, the market suddenly had to process the possibility of increased selling pressure from early investors. The stock fell sharply around that time. But it's important to be precise about what is happening here. The lockup expiry didn't change the company's fundamentals. What it changed was the information environment. More potential supply, visible insider selling behavior, and increased uncertainty about short-term flows. And markets often react to that kind of new information even when the underlying business hasn't changed. When you step back, a pattern becomes clear. A year after the IPO, we now have multiple earnings reports, analyst coverage, insider activity, and more refined expectations. In other words, uncertainty has gradually been replaced by information. And this is what price discovery really is. So let's come back to the original question. Is the IPO really the best time to buy a stock? From a long-term investor's perspective, the answer is usually no. At the IPO, information asymmetry is at its highest. Insiders know far more about the business than public investors, who are still relying on limited disclosures and early narratives. The real picture only becomes clearer over time through earnings, guidance, and how the business performs in public markets. That is when the market starts separating story from evidence. So while IPOs can be exciting, they are often the least informed point to make a long-term investment decision. For many investors, it might make more sense to wait for a few quarters of results before building conviction. The IPO is not the moment value is revealed. It's where it starts to be discovered. I hope you found this useful. Feel free to leave your comments below. Stay focused everyone, and I'll see you next time.